Well, I think that leads to that second driver you were talking about, Brian, which is it's going to continue to drive Fed that's going to be falling further behind the curve and therefore has to move rates up further and faster. And really that's what we're seeing. Fed Governor Brainerd yesterday kind of set off a little bit of a panic or a fear in the market about the balance sheet, and the market hasn't focused on that. But those are the kind of tools which are blunt that the Fed's going to try to push. And what that means for the markets are continued volatility around the uncertainty to higher rates and lower income cash flow stocks, growth type stocks, probably continue to get discounted as rates rise.
Is there any part of the stock market that looks inexpensive to you? Not just fairly valued, Cliff, but maybe inexpensive, given that multiples have now come down?
Yeah, we think the whole value sector of the market, areas like financials and select financials, insurance in particular. I mean, PE ratios, are very attractive. The fundamentals for value-oriented companies and quality companies are solid, and they're also very defensive. In a playbook that maybe we have to go back to, normal inflation, not 70s, but periods where inflation is rising, what has worked? And that's generally been income-oriented and value sectors of the market.
Yeah, and what do you make of the current outlook? I mean, we've had guests on who said we just don't know what's going to happen. Normally it's pretty clear, but with the war in Ukraine, with rates where they are, with the Fed talking about a speedy reduction of its balance sheet, I'm not sure the visibility to the summer or fall, Cliff, is that great. What do you think?
I agree with your last statement, Brian. I think it's going to be cloudy because we haven't even seen inflation come off the peak yet. It's still peaking. And again, we see the Fed that, even though they've begun to move, rate moves move with a one-year lag. So even if they go to 225 on rates, we're at the end of the year, higher than their existing forecast. That just averages a Fed funds rate of 1.25. That's way behind the curve. So I think we'll be sitting here in the fall looking to try to find that clarity, which we might not be seeing. So I think really the playbook is take a step back, look at an environment where rates continue to rise, inflation is sticky, and maybe we're in essence aging in that cycle. And I think we need to expect shorter cycles as we move forward in time.